Warm welcome to the Risk Reversal Podcast. Guy Adami here, always joined by the great Dan Nathan. Dan, how are you?
I'm doing great. I'm doing great. You call me great. I'm doing great. I probably feel like $100 though. After it was a long week.
Well, you know, adjusted for inflation, $100 isn't what it used to be. But last week was a fascinating week. A lot to talk about this week, and we have some pretty cool guests coming up as well.
Yeah, just let me take a quick step back. I had Daniel Schreiber. He's the CEO of Lemonade. This is an AI-powered insurance platform. We had a great conversation about actual use cases for AI, and he built this company on AI, and they use it for a whole host of different reasons. So that's a great conversation because I really, at this point, Guy, we spend a lot of time talking about infrastructure and the build and, what is going to come. Here's a company that's already benefited from this technology. So that was Lemonade. That was last week. Today, after this, Spiridellis Brothers Studio, Gregg Spiridellis, he started an AI-powered animation studio. He has had tremendous success. Storybots, Jib Jab. You were Jib Jab once, weren't you, Guy? Or you were kind of using that platform?
There was a period of time where Jib Jab was, you couldn't turn around without seeing a Jib Jab of something. As a matter of fact, Amanda Diaz, by the way, folks, Amanda is doing great. I think she spearheaded a Fast Money campaign using the Jib Jab.
Yeah, so Greg was on Fast Money, I think a couple weeks ago, laying out their vision and how they're using AI. And again, he's actually really bullish on the technology, that it's not going to displace workers, that sort of thing. And you keep hearing this. It's going to be a bit of a jetpack for a lot of creative folks. So again, great conversation, another use case for AI. And then, Guy, as the Fed, they're all important. OCC 29 rate decision, which CME Fed Fund Futures is saying it's a lock after the CPI data, 25 basis point cut. We have Mike Wilson of Morgan Stanley in the studio during the presser with Fed Chair Powell. So that's going to drop on Thursday. We're excited about that, aren't we, Guy?
Very excited, and this is how my mind works. Of course, you mentioned Lemonade. The first thing I think of course, is the great Eddie Murphy when Lemonade,
that
remember in Elvis Presley, that cool, refreshing drink. Yes. And then you said he built something. Then, of course, I think of the very shitty song, We Built This City on Rock and Roll. That's just, it's amazing how just twisted I can be. But there is a lot to talk about. Obviously, we also have Halloween this week on a Friday. Which is spooky. Always sort of fun and interesting. So we'll see. But look, last week, if you remember the movie, it's a mad world. I'm sure you never saw it.
Well, hold on. Of course I did. This is a mid-'70s or late 70s movie where all these celebs playing themselves were on this global or national, I don't know, what do you call it? A hunt? What do you call those things?
They were looking, they came upon a car accident, and the person that was involved in the car accident said that there was a buried treasure basically under a giant W. And then it sent all these people into this sort of firestorm of looking for and it's a great movie.
By the way, wait, I got to finish this for a second. So,
okay,
I'm a bit younger than you. Okay. Let's just be clear.
Just a bit.
You probably, and this is not a joke, you probably saw that movie in the theaters, no doubt about it. Okay. When it came out, I was probably mid-single digits, but there was so little to watch on TV back then that these movies would run and run. Am I right? Like they would just run and run and run. So I did see that.
If you haven't seen it, it's brilliant.
We'll put it in the show notes. All right. So a mad world.
Anyway, Ethel Merman is in that movie, recall. She was the mother-in-law and she was a pain in the ass. But, for you fans of Ethel Merman out there, by the way, I did see the movie in the drive-in after the sock hop at our local high school. But she used to sing a song, Everything's Coming Up Roses. And in terms of what we're seeing for a myriad of different reasons, everything is coming up roses. You have an S&P 500 that finally got through a level that a lot of people are talking about 6,800, which I thought was an absolute pipe dream back in the spring. Yet here we are, obviously the NASDAQ doing its thing. A VIX, by the way, which spiked above 25 at one point, now back below 17. So, you're hard pressed to it's hard to throw stones here. The CPI number on Friday that was, I think still problematic, but softer than the market was looking for. And, right now it's all systems go, apparently, for the broader market.
All right. And there's obviously some AI news, and we're going to hit that. I mean, AI in the just everything around it, guy, is just it's just driving the train. I mean, look, because I'm looking at my FactSet screen from Friday, right? And I see obviously a sea of green, but there's plenty of stuff that's red. I think it's some of the consumer related sort of, retail and the like here. But until the fever breaks around AI, the market just continues to grind higher. And one thing about that 6,800 number in the S&P 500, you and I were not pressing lows back in the throes of that sell-off in April. But man, when it got to 5,850 or 5,900, we're like, you just got to let them rip right here, because the idea that we would have been above 6,000 to us seemed a bit crazy. Now, there are a couple things. We had John Butters on the market call last week, and some of his data about earnings revisions higher, not lower, is basically empowering investors to come up with a scenario that earnings growth for this year is going to come in that low teens, right? Which is where it was the expectation late last year, and then also low teens for next year, 2026. So folks are not having a hard time coming up with that 22 and a half times, or 23 times, which historically is very high.
And what people will tell you, yes, it's historically high, but again, this new paradigm where, today's 22 and a half, 23 is probably more akin to 5 years ago's 18 and a half, 19. And listen, people can justify a lot of things when things are going well. And you're right. When in April, when the S&P traded down to, where did we get down to in April?
48.
Like basically 4850 or something.
Yeah.
I thought maybe we'd get back to 5,700, sort of a 50% retracement of the prior all-time high, which, by the way, happened in February. And I'm like, yeah, all right, that sort of makes sense. And then we'll sort of do a back and fill. And it never really looked back. There have been days here and there along the edges, but it's been a straight line from 4,800 to 6,800, which is remarkable.
Yeah. So going back to that whole theme, Guy, about AI. Next week or this week, with all the earnings, we get all the Mag 5, 6, whatever the heck it is, right? Tesla was last week, and Tesla remains, somewhat weak, 438, high 430s or something like that. And it'll be interesting to see whether investors really drill down on the auto business, or they just remain very focused on robots and robotaxi. I think obviously that's all on the come. But, the underperformance of, let's say, NVIDIA, Microsoft, and Meta as we go into earnings. Again, NVIDIA won't report for a month or so, is worth noting. And we'll hit it later on in the podcast over the course of the week. But might you see some sort of hiccup? Whether they reaffirm CapEx or raise CapEx or lower CapEx, I can't tell you how investors are going to perceive a cut or a raise. Just staying flat, fine, whatever. You know what I mean? Then it comes down to the guidance of the business, right? But it is interesting that underperformance we're seeing right now.
Microsoft, to me, is absolutely the main event. And you may have a different view, and as they say, that's what makes markets. But, Microsoft, which we had talked about, had been a huge underperformer for the majority of this year since the summer of 2024. It's a stock that made its all-time high in July of 2024. I think about 470 or so, spent the next 6 months going lower to sideways. And then obviously, like a lot of things, cascaded lower in April. Since that April low of about, I want to say 365, 370. Think about the move that this stock has had. Pulled back a little from the all-time high of about 555, but here we are in the mid 520s. Big valuation, big market cap approaching $4 trillion. They're going to have to deliver on a number of different metrics at this valuation, in my opinion. And look, they've done it before, but this stock has gotten itself expensive again, in my opinion.
All right. So talking about that, prior high, when they reported this last quarter, I think it was like the first day of August, Guy, the stock gapped up 8%. The all-time high was the opening tick the next morning. It gave most of it back. It filled in that huge gap. And think about this. This is a $4 trillion market cap company, filled in a 10% gap. So that's basically almost a $500 billion. And then it's gone sideways. It's traded between, 505 and 555 or 550 or something like that. So I agree with you. This is one of the main events. I feel like if they were to just put up a quarter that's good enough and guide in line, that doesn't make anything more clear about, you know what I mean? But maybe it is somewhat Microsoft specific. Meta is one that I find interesting because of the spend. This has been going on now for 3 or 4 months. They've spent hundreds of millions of dollars attracting talent away from Apple, away from Google and OpenAI and that sort of thing. And, since that stock gapped up to a new all-time high going back to early August, it's been stuck in the mud. So when you have huge market leaders like Meta and Microsoft that have not confirmed the new highs in their major, whether it's the S&P or the NASDAQ 100, it is worth noting.
This is amazing to me that you think about the head start that Facebook had over the years and how, in terms of just market cap, Microsoft has lapped them now a couple different times. So as great of a company as Facebook is, Microsoft very quietly right before our very eyes, and we have said this, it's made itself one of the top, I would say 3, if not, top 3 or 5 companies in the world for a lot of different reasons. But you're right again to point out the underperformance of Facebook since August. Again, I think 795 or something in the middle of August, and we've traded sideways to slightly lower since. Now, the optimist is going to say, you know what, Dan, go back and look where we sort of holding here. We're holding at the prior all-time high from February of this year of around 730-ish, and that's encouraging. So people will say it's building a base in earnings. Other people will saying it's petering out on what's been a good tape. It remains to be seen. I would not surprise me, and this is just me, it would not surprise me to have some headline, Facebook, takes once again a $2 trillion company, stock trading above 800. And it sounds ridiculous, but not in today's market.
All right. So we just talked about underperformance, and I mentioned earlier some of the consumer related stuff. So Netflix sold off 10% after its results, and it really was trading much like Microsoft. Had never confirmed any of those new highs in the major indices and had been going sideways below those highs. Take a look at Spotify. You could say, well, that's very similar. Instacart, DoorDash, Uber, and there's a handful of Airbnb. These stocks are all well off their highs, okay? And so a lot of consumer digital names are not trading well. And again, I'm not cherry picking. I'm just like, I spend a lot of time just staring at tech stocks, you know what I mean? And it's really notable because these are away from the AI trade, right? So the market has had no problem. The NASDAQ has had no problem making new highs despite a lot of names within the index that are not trading well.
Yeah, and it's funny you mentioned Instacart because I just looked at my American Express bill and I noticed a bunch of, and I couldn't find, I mean, I'm sure you can get it on your application store. I don't have it, but yet I have bills from it. I also have 3 children, 2 of which I'm sure use it extensively. I know for a fact one doesn't because I just know that he doesn't.
That's
With all that
boom.
said,
I'm going to call him out. That's boom, boom.
That is boom, boom. This is a stock that, again, since February of this year has not, this is Instacart. I mean, it's not traded particularly well. I think the all-time high was 53. Here we are below $40 on what's been a good tape. And you mentioned it, but I'll mention it again. You would think a name like this, given the momentum and given just sort of the juices that are flowing, you would have thought somebody was going to take this thing and run with it to the upside. But you're right. It's sort of been floundering at best.
Yeah. Let's talk banks. There was a sea of green in the banks last week. And, this is one where because now rate cuts are a certainty, like the one thing before we actually talk about the banks, and again, none of them are at their all-time highs. If I'm looking at JP, I'm looking at Bank, I'm looking at Citi, I'm looking at Goldman and Morgan. They feel like they could easily be there. But we have this Fed funds that's going to be at 4.25 and then probably in December on the high end at 4. Okay. But look at the 10-year, which is basically stuck here at 4%. Do you think when it becomes a near certainty of a Fed rate cut, okay, for two more times, does the 10-year start to move higher?
That's what I thought for a while. I looked pretty smart right after this last rate cut in September as rates briefly went below 4%. And within a week or so, they were trading almost to 4.2%. We've round tripped the entire thing. But I will answer your question. Yes, I do think there's that possibility. As a matter of fact, we spoke to Liz Thomas about it and some of the relationship problems that she was seeing. And this was one of them. And you're right. I mean, banks have traded well. The problem, of course, is, when Jamie Dimon tells you his company is too expensive on a number of different metrics to be buying back stock. I mean, you don't have to agree with him, but you have to listen to him. And, who would know better than him? Now, if I'm being entirely honest, he also said that a year or so ago when the stock was trading about 210, if you recall, and he made the same type of comment and the stock proceeded to go up 50%. So, he can be just as wrong as me, which is pretty amazing if you think about it. But he brings up a good point. I mean, banks are being rewarded over and over again for seemingly the same news. And since you mentioned the Fed, we sat down with Stuart Sopp, the co-founder of Current, and he actually posited that there's a potential for, although I don't agree with him, but he thought there was a relatively decent chance, more than 25% chance, that the Fed actually cuts by 50 basis points this week, which I don't see happening. But I think some people are coming around to that logic, and maybe that's another reason you're seeing the market move the way it is.
Well, I guess. I mean, CME Fed Fund futures are not moving in that regard. And, the hard part about this is that we don't have the employment data. I know that ADP had some data out that's a private, number. So I just feel it would be very unlikely for the Fed to do more than it's expected in an environment where we just don't have a lot of visibility to the data. That's my take. But what I also found interesting with Stuart's commentary is just really this whole notion of a K-shaped recovery guy. And maybe that's what we're seeing in the markets too, a sort of K-shaped market. But he gave us a good sense of what a lower end consumer, some of the issues that they're facing right now, and throw on there, obviously a weakening labor market, even if it were to not be as bad as that last print that we saw over the summer. What was that? That was an August print. Is that the last data that we've gotten?
I think that's the last one. Don't at me.
Yeah, it's not likely to have improved or like maybe it's worse than expected because of the shutdown. We got a lot of furloughed workers. We got a lot of workers that are being cut. We see the whole thing going on with immigration. So there's going to be a lot of stuff there. But I can't imagine the Fed under those circumstances surprising the market.
I don't think so either. I mean, I was interested to hear Stu's take on it. He obviously, in a past life, he's somebody that traded currencies, traded commodities, and he's a Fed watcher in ways that, I think you are and I am as well. I mean, he gets into the weeds with this stuff. So he didn't throw it out there sort of willy-nilly. Again, I don't think it's happening, but the fact that people are even talking about that, I think is somewhat remarkable.
All right, we got to talk autos. GM, what was it, up 15% or something after those results? Is that a new all-time high, I think?
Right? For the new GM it was. And remember, so GM, this is the second iteration of General Motors. So yeah, that $69 level was a new all-time high. And again, don't at me, but I think this was a stock that started a gain sometime in 2010-ish. I think it was the fall.
Late 10, I think it was.
Yeah,
very
so here we are at $69. And if you watch Market Call, if you watch Fast Money, this is a name we've done a decent job with. What we have said over and over again was, although tariffs are a problem for a lot of companies, this administration are not going to let names like General Motors in terms of the stock fall that much. And I thought the right level was sort of 45-ish in terms of a floor. And to a large extent, that's been right. And now here we are at $69 or so. I don't think this is just me. I don't think you're chasing General Motors here. I definitely think you could see a relief sort of sell off back down to the high 50s, low 60s, but it's been in a pretty impressive run.
Yeah. It's hard. I mean, you could say don't chase stuff, and that's not my jam. I'm not like a buyer of big breakouts after huge runs or anything like that. But a chase is what's going on in the market.
Yeah, chase is what's going on.
Folks are just scared as shitless, to miss stuff. And, the semis and some of the storage names and all that sort of stuff, they are the ones that I think a lot of folks said, oh, okay, like we got the hyperscalers, we got to, NVIDIA, now AMD gets this contract, Oracle gets this, they're coming after everything. And then if you just look at, SanDisk and Western Digital and Seagate, I mean, you could have bought all you wanted of these stocks a year ago. I mean, it's just insane. And we were just looking at SanDisk has gone from $40 or a little below $40 less than a year ago to where it is right now at $183. You know what I mean?
Yeah,
So like,
it's incredible.
but like if you're doing this like this, I don't know, man, you're doing it wrong. And then, chasing an Intel into that print because the PC refresh cycle, the stock opened up 7 or 8% Friday morning. And now, it's down. It gave all that back.
Dan, what month is this?
This is October.
SanDisk was a $50 stock in September, 50, as you just said. This is September. It's not like this is September of last year. This was September of this year. You don't seem, and it's not a small company. It probably is a $20 billion company now. It's to me, it's insanity. But that's just me. By the way, as we've been talking, and I thought it was early 70s like you. It's a Mad World was released in 1963.
What?
The year of my birth, 1963.
Deck 18, it's coming up, people. All right, last thing, Guy, before we get out of here. Is there one name that's reporting this week that you find really interesting? Again, you just mentioned Microsoft. Away from that, on Wednesday, we have Microsoft, Google, Meta, Cat, ServiceNow, Boeing. And then on Thursday, Apple, Amazon, Lilly, MasterCard, Merck. And then Friday morning, Exxon, Chevron, and Colgate.
Yeah, energy's fun, but I don't know if it's going to move the needle. Eli Lilly, they have to say something pretty outstanding in order to justify this valuation. I'm not necessarily watching that, but I think given all the excitement around Apple, I don't know what they're going to say to get the next leg higher. They better say something because to me the valuation, especially where we are right here, doesn't make a whole hell of a lot of sense.
Yeah, I was going to go with Apple too, and just.
Oh, I'm sorry.
No.
I can change my answer.
No, for not two different reasons. Because the stock has had this huge ramp. I love, and I say this all the time, I love to see investor reactions after earnings. The idea of playing into them is really hard unless you are super convicted. And that's why I brought up the Intel, because people are all geeked up about it. And you get a gap like this. Just think if you're a short covering or you're buying it long or this or whatever, and then you get the reversal, it's got to make you think, you know what I mean? Like something very different than you were thinking 12 hours before. So that's it, Guy Adami. Big week, as we started out by saying. We got Mike Wilson on the pod. We have Greg Spiridellis. Check that one out. We had Daniel Schreiber. We had Stuart Sopp. We had a monsters sort of.
We're not effing around here. I mean, we're going. I don't know if I'm allowed to use this term, but I'll use it. Yeah. We're going balls to the wall as we get towards the end of the year.
It's balls to the wall. All right, everyone. Thanks for being here. Stick around for my conversation with Greg. All right, welcome to the Risk Reversal Podcast. I am Dan Nathan. I am joined by my friend Gregg Spiridellis. He is the co-founder of Spiridellis Bros Studio. Greg, welcome to the podcast.
Thank you for having me, Dan. I'm a big fan, actually.
All right. Well, we got thank you, by the way. Before I just kind of, skate over that a bit, your lovely, lovely friend, Katie, has been on this podcast on many occasions. And we hope to maybe all three of us sit down in one place and do that sometime very soon.
Fun.
But you've had some really, really interesting news. And it's not just obviously in your life or your brother's life, but it's, I think, in the industry. And we're going to talk a little bit about the studio that you founded. We're going to talk about where you think the media business in general, I think a lot of streaming, a lot of animation, these are all things that you've been focused on in your career for a long time. But let's take a step back a little bit. I mean, I know your background. I think it'd be really interesting for the listener, the viewer, to hear how you got to where you are right now, because it's not like you're just a Johnny-come-lately in this kind of animation, original content, AI game. You've been at the forefront of technology for 30 years. Not only have you been an entrepreneur, but you've also been an artist, and you've created some really great brands, and you sold those brands. You won awards for those brands. So let's start at the beginning here, man.
Oh, okay. So we start at the very beginning. Was actually I worked at Bear Stearns and Goldman Sachs.
Oof. So, well, actually, that was the end for Bear Stearns, by the way. But
yeah, exactly. Yeah, it was all over. I worked in the CDO business. No, I actually. I was in investment banking. I went to Wharton. I was doing my degree. It was 97 to 99. The vision was I was going to go do private equity. And then I saw a full motion streaming cartoon over a phone line, and my head nearly exploded. In my mind, I saw that and I said, everything is about to change. This is going to change everything. My brother was an animator who had won a bunch of independent film awards and was doing a lot of work with digital photography and animation and wanted to do a television show. And, as he recalls it, I said, you're banging out horseshoes. The Model T is coming off the line. Like, stop looking at television. Come look at this. And we started, after I graduated, I said, I'll never be this poor or this independent. I wasn't married. I didn't have kids. Let's hang a shingle and see if we can make something work. And so we spent 5 years. And then in 2004, we had probably one of the first viral video hits. It was Bush and Kerry singing "This Land Is Your Land." It was an election satire. And it really kind of ignited everything. And to give you a sense of time, that was before YouTube. So YouTube came in January 2005. Anyway, over the years, built the Jib Jab brand. We got into, from short form comedy to personalized entertainment. We did Elf Yourself and a lot of other businesses that let you put yourself and your friends into videos. We built that into a pretty substantial subscription business that we sold to a private equity firm in 2018. And along the way, it started a separate company called Storybots. And the idea was we could build a big audience on YouTube for a kids franchise and move it to television. And when we saw that Netflix was, we made the bet that Netflix was going to start producing original entertainment, invested $3 million of our own money, which you're never supposed to do in season one of this, thinking that Netflix was going to need this. And luckily they did. And we the show wound up winning 11 Emmys, and Netflix bought the company in 2019. And we worked as producers at Netflix for 4 years before starting the studio.
All right. So here you are, you're starting a new studio. And for the last 30 years, like I said before, you've been on the forefront of this technology, enabling you and your brother to create this and to build fandom and then actually get them to pay for it and then get distributing rights probably and then selling this sort of stuff. And like, this is the story of the models that work really well today. And you've been doing it for decades. So let's talk about, what are you in front of right now with the company, the studio that you just launched? Because it seems like you and your brother, you have a good eye for this sort of stuff.
Yeah. All of these past technology waves have really unlocked what we think of as like there's the creation, production, and distribution of content. And I think if you look at the internet, it was really about distribution. How do these technologies change the way you can get content out to an audience and the way that you can engage those audiences? And I think the big shift in what we're seeing right now is that AI unlocks incredible opportunities on the creation, the ideation of new content, the ability to produce things that you would never be able to produce before, kind of at budget levels that independent studios can operate, are the two key things that we see changing the landscape right now.
Yeah, and you hear so much about generative AI, and you just used a good term about producing the content, right? So let's take a step back to like what that means. You are artists, you employ other artists, right? You kind of create stories, you have a vision for that sort of thing. AI is probably an amazing tool, but the idea of having it generate itself is probably not something that you're that interested in. To kind of explain that right now, because I think that people throw around generative AI a lot. I remember in the early days of ChatGPT, going back 2.5 years, you remember all those kind of stories written about the hallucinations and how these things will just go, and you can program it to do a 24-hour Seinfeld thing or something like that. And I don't think there was a whole heck of a lot of demand for that sort of content, which is why we're not talking about it anymore generally.
Yeah. At the end of the day, this is a force multiplier for creators and artists. And that is the way we see the world. Now, there are people and there are probably businesses who are saying, how can we do the same thing we've always done cheaper as a result of these tools? What we're thinking about is, what do these tools enable for independent artists and creators that were never before possible because of barriers to entry that, were primarily capital driven, right? Pixar movie costs $150, $200 million. So for us, These tools are not about doing the same thing that's always been done faster and cheaper. It's about how do we use these tools to make things that people have never seen before. And I can promise you, there is a lot of fear across all industries about AI taking jobs. But AI is nowhere near on its own, I will say, like on its own, telling stories that resonate with other humans and producing great art that inspires people. What these tools do is, in the hands of great artists, they enable them to do things that they could never do before.
Yeah. So the company is literally exists to empower artists to do the things that you just described. So let's just talk about the structure of the company then. You just kind of described this as being, let's call it a jetpack for creators, right? So what differentiates what you guys have created, relative to, let's say, other studios that exist, the sort of studios that would find this sort of talent and enlist them to kind of create content?
Yeah, I think if you look at the traditional studios, they're organized around producing one very big thing and engaging the artists in pipelines that are now, looking back to Toy Story, 25 years old, just in kind of in digital animation world. What we see is the way that these movies, and let's stick with movies as an example, are going to get made is going to completely change. These tools are going to shatter the production pipelines, and the way you organize creators and artists around the making of something is going to be completely different than the way it is in the world today. And so at a high level, we say, instead of producing one movie for $150 million, imagine if you could produce 6 for $25 million each. More stories as a studio, diversification, more shots on goal, and actually economic opportunities for each of those projects that reduce risk around getting a return on the capital invested.
So you used the term fear before, and this is something that you see in a lot of different industries, but creative industries, first and foremost. And no one knows how this is going to shake out. And I think the way you describe what this technology can do for creatives, that must be really exciting for people and young people who actually don't work under the constraints that, let's say, you or I have over the last 30 years or so. What is the vision? You have a murderer's row of investors in the new company. Describe some of them, where they're coming from, and what part of the story that you're selling are they really all in for?
We're trying to find the artists who are excited about these technologies, who recognize that these are force multipliers on what they can create, on their ability to actually take what's in their head and realize it in a form that can be shared with other people. And it's very bifurcated. I mean, the pitchforks are out. The traditional animation, industry, and really kind of just the broader creative industry are scared, and I understand that fear, because you can look at this and say, oh my gosh, like that piece of software can do what it took, in a few minutes, what it would take a person to do in days or weeks.
Yeah.
So, but the question is, how can, with more productions, with the ability to produce more things, to engage more people, to tell more stories, we think that is going to create actually net more opportunities for artists, more productions, just not like those giant big tentpoles, but to actually diversify that to lots of smaller productions and tell more stories. If you had an animated feature film that you wanted to tell that story in the world 5 years ago, you might be one of, less than a dozen people in the world who get to do that. And I think now we're going to see that opportunity be democratized and be available to a lot more people. So that's the, as you think about, what we say to every artist is, you can run towards this technology or you can get run over by it. That is the fork in the road right now. And the artists we want to work with are the ones who see this as a new canvas for them to expand what they do creatively. So
yeah, and on the investor front, you just used the term fork in the road. I mean, some of them are probably very cognizant of the fact that there's going to be some sort of debate about the route in which you're taking. It's going to try to disintermediate some of the existing sort of infrastructure that is stuck for a long time, that sort of thing. So what do some of the investors see about this? Obviously, you and your brother have a great track record in creating content, distributing content, monetizing content. What's different right now?
Yeah, I think the existing investors see the opportunity for us to completely transform the way content's created, produced, and distributed. Like that if you were to start at ground zero today and say, how should these productions come to life with the tools that are now available, it wouldn't look anything like what it looks like for the big studios. And they are hamstrung by existing pipelines, existing software, and also the existing way a lot of the creative people in the world see the way these things get made. You know, this is the way it's always been done. So this is the way it's got to be done. So I think what our investors see is, you know, two founders who have reinvented themselves and rode every wave of technology for the past 25 years and say, wow, like, before we used to play in small spaces, you know, online shorts and personalized entertainment, and we could build nice businesses. But now if you're Pixar, if you're DreamWorks, I think you have to really think about your cost structure and your approach to producing movies and all of that value that is going to be up for grabs. If you look at the top quartile of animated feature films over the past decade, the median film in that kind of that top group grossed over $1 billion in worldwide box office. Like, that's just a movie. Forget all the sequels and television shows and licensing and merchandising. So there is an enormous opportunity to create a lot of value if we can kind of wedge ourselves into where traditionally only the really big studios have been able to.
All right. So much to do there for a second. So let's just talk about that. So you're saying these top movies coming out of Hollywood, they're predominantly, the biggest grossers are animation, correct? And is that one of the reasons why you and your brother, A, are drawn to animation, B, you obviously have success there. But what percentage of, let's say, full length films are animation? And then does animation just kind of dominate on the web as it relates to, like, you know, streaming, UGC, that sort of stuff?
So in terms of box office, I'm looking at it a little bit differently, which is like global box office in 2024 versus 2019 pre-pandemic is down about 30 to 40%. If you look at what's happened in animated family features, it's grown. The market is bigger now than it was pre-pandemic. And why is that? It's because going to the movies as a family is an event. It's something to do on a Saturday or Sunday. And anybody who has young kids knows, like, you are trying to fill those weekend hours. And so we see continued strength in the box office. So we see a real lane open here for theatrical, because those home runs are in the $1 billion range. But the more interesting thing from a risk reward profile is that bottom quartile, the median film does about 40 million in box office gross. So if you're talking about doing a film for 20 million, maybe a little bit less, boy, that risk reward profile looks really good. And if you can take 6 swings, you know, at 25 million versus 1 at 150, we think that looks really good over the next 5 years. And so that's enough time for us to build a franchise and get it out there and try to tap into that, you know, what we see is like a really big market opportunity. And on the digital side, animation is just, there's so much we can do. There's so many emerging formats. I know NFTs got a bad name in the last kind of boom bust cycle, but man, we see huge opportunities for collectibles and fan engagement and community building that not only present really interesting monetization opportunities in digital channels, but also build that fan base to get those people into the theater, so that when we go to the streamers and say, who wants the television series? We're not showing up with the television series and relying on some development executive to tell us whether we're good or not. It's like, no, look, we've got, tens of millions of people behind us online, and you can look at all the engagement, and it becomes it's where we get our leverage.
Yeah.
It's how we did it with Storybots. Before we sold the company to Netflix, before we sold them the show, we built an audience on YouTube, and that's the only leverage you really can get is you show up with attention. And the big distributors, that's their love language.
Attention, engagement, community. But again, they probably don't need to be on a blockchain to do that. Is probably my guess. But just to kind of put a bow on this, so like the idea would be to take a barbell approach, right? So the digital, and that probably looks more short form, and then the large feature on the other side. You probably take a lot more shots on goal with the digital streaming sort of stuff, and then that helps you kind of prove the model. What would you say? You just mentioned like a Pixar. And the cost structure there. And I've heard you talk about some numbers of what goes into creating one of those. And they only get one a year, two a year tops or something like that. And to your point, it's not a guarantee that it's going to be $1 billion sort of thing. But what do you guys think, like, given your infrastructure and your model, like how many feature films do you think you'd make in a year?
Oh, I don't, we're not thinking about quantity yet. We're thinking about quality, and we're also thinking about it in a life cycle sense. So you mentioned it is a barbell, and that first part of that barbell is like nailing the online channel, because not only there are revenue opportunities there, but for experimentation, seeing what works, seeing what the audience responds to, experimenting with different production pipeline tools to understand, okay, this is what we want to achieve. How can we achieve it? Well, you're in a feature film production. You can't really be messing with your pipeline and your tools and your technologies. But when you're pushing out new content every day online, it's a great way to do experimentation and really prepare yourself for that big hit. So the way we're thinking about it is we will be developing online, and we're also now working towards one family feature. And there's a great quote. I think it's Andrew Carnegie with the feature film. It's put all your eggs in one basket and then watch that bleeping basket. That's how we're thinking about the movie.
You said something interesting that you had that jingle. What was it? The Carrie and
This land is your land.
Yeah, this year land. And it was in 2004, and it was, a year or so before YouTube. And then all of a sudden, no one even knew what virality was as it relates to digital, and I think Lazy Sunday, you remember that, the SNL short?
Oh, yeah. Saturday Night Live skit made YouTube built on the pirated piece of content.
Yeah. Now flash forward 20 years. YouTube is, one of the biggest, platforms on the planet. You can make it's one of the, probably the most important, if you want to call it social, platforms on the planet. And, I think about what you just said, like from a distribution standpoint, I think the existing rails are going to be really important, right? Like, how do you do that? How do you create distribution and community engagement, all that sort of stuff? And so I'm just curious, when you think about these different platforms, we know that like Amazon Prime's huge, and, there's all these different services where, it's one thing to be ad supported and just an open network, another thing to be subscription. And obviously you have to get that placed and sold and everything like that. But it seems like there are just so many opportunities to kind of get your content out to the world, and you don't even need to own distribution. Is that correct? Or is it just about the high quality content that you have to basically go out there and put on different rails?
Yeah, I think, well, first of all, it's forever. We had a saying, my brother and I would say, the audience is the network. It's not the pipe. It's not the one destination. The audience is your distribution. And so, and what does that mean? It means if someone discovers something funny on Instagram Reels and shares it with a friend, like that is our network. We don't need to, we never would own the direct, a destination per se. But I think there are so many channels available today to aggregate these audiences. And then the question is, how do you monetize those audiences? And so there are ad obviously opportunities on those channels and ad sharing opportunities. But I think the real interesting thing becomes, how do you leverage those audiences to go to really big channels where the really big money is? Serialized content on a streamer, a movie like we've been talking about, and bringing that audience to those bigger money channels.
Like, assuming that you're going to be successful and knowing you and your brother and your track record, you will, really obviously harnessing this new technology and providing different ways in which artists, creators can kind of get their work out in the world, and kind of having folks like you guys who understand this changing dynamic because you've done it before over different cycles. I have to assume that there's going to be a lot of folks coming after you guys. Like, talk to me about the establishment. Like, how do you think your studio is going to be viewed from some of the power brokers that exist there, and those that have like lots of reasons to kind of defend their moats?
Oh yeah. I think I would be scared if I were the captain of a battleship and I saw, the drones coming, or the little remote control speedboats coming around. Like, I would be scared, because I think their entire, not only the cost structure, not only the traditional channels that they've relied on for monetization, but the culture of the people saying, what do we make? How do we make it? That's all changing. And there's a lot of legacy infrastructure, not only internally to the studios, but unions. And I think I look at the world and I look at a lot of the things unions lean into on the negotiations. I say, why are you fighting for that? You should be fighting for this. And I think a lot of those structural, elements are going to make it very, very hard for them to move. And I think this is the best time. I've been doing this 25 years. This is the absolute most amazing time to be building something. It's like everything before was just basically training for this moment, because really before it was the big guys had time to move. And I think this time I just don't see how they can get themselves nimble enough to really deliver innovative, programming.
Well, it takes you back, like you said, 30 years ago. I mean, Pixar turned the entire movie business upside down. And then when you think about, just kind of what the internet did, and then you think about like the ability to folks like you and your brother to go out and create content and build an audience for it and monetize it. I mean, it's been going on. And then you think about these established players, whether it's the studios, whether it was, existing TV network. I mean, the list goes on and on. Never have we been in a situation, and this business far better than I, where things have just been so, they're just coming apart at the seams, it seems like. And it seems like a lot of these big conglomerates don't even know what to do with themselves. They bundled, they unbundled, they bundled again, then they streamed it, and then, that sort of thing. Help us make some sense to that, because, we're seeing a lot of big moves by a lot of big media companies right now. And do you think some of this stuff is going to sort itself out, or is there going to be a lot of like nimbler players? When you think about what's going on, like NBC Universal, for instance, and this is not a good analogy, but they're punting out, some of their cable networks, like 4 or 5 of them, just so they can focus on how to build within new mediums and grow the audience away from traditional. It just seems like that's a story that we're going to hear again and again over the next few years.
Totally. It's the innovator's dilemma. It's just the innovator's dilemma. And you can shuffle the chairs on the deck of the Titanic, or you can say these are profitable businesses, but maybe they're getting in the way of us facing the music, which is content formats are changing, distribution channels are changing, monetization methods are changing, and we better figure out, how do we kind of get ourselves, out of our comfort zone and experimenting in some of these areas. And I think that's the lane for us. And clearly these are big businesses with insanely valuable assets, and they'll figure out ways to kind of to transition. But I think, you say like what they look like 5 years from now versus today. It's impossible to think they look anything like what they look like today.
All right. And so this is one of the last ones I have for you. So we haven't mentioned the term AI a lot so far. We're talking about like the existing media, ecosystem, how it's changed. What are some of the things that work? What are the most important components of it? That sort of thing. What will make it important in the future? If generative AI didn't exist in the form in which it does, it doesn't have, it hasn't captivated the planet, and it really is the planet the way it has, whether you're a consumer, whether you're a business, whether you're a government. I mean, the list goes on and on. How important is the technology to your whole thesis? If we were still ChatGPT 1 right now, would you even be doing this with your brother?
We would be creating content, but we would not have such a bold vision as to what's possible. AI really changes everything. The last moat of the big studios was, used to be capital for distribution. You couldn't get a television show on the air. You couldn't ship film canisters around the country. Like, that was the moat. And now, like, with AI, the mode of production, the fact that you needed hundreds of millions of dollars, the fact that you needed to organize 600 people around a project, like, that is gone. And so you really, I love, one of the things I look at is, Snow White, the first Disney animated feature, was 700 people. Like, Lion King is 600, Toy Story is 120, and Flow, which was a movie made with AI by a core team of 20 people in Latvia for less than $4 million, won the Academy Award last year. So, the barbarians aren't at the gate, they're crawling over it right now. And so that's our path. We're going over the top too.
All right. Very last thing. So I listened to all this and I've been following your story here, and every step of the way I say to myself, oh man, did they wrap up Quibi just a couple years too soon? When you think about this thing, because, it might have had the right idea. It had the wrong cost structure. Does that make some sense? So, like, going back to like what this was, I think there was a lot of excitement about this sort of thing, but they like spent so much money having like real live movie stars in little 3-minute sort of episodes. Like, is that going to be something they're like, damn it, I just missed it by a few years?
I think, it's probably the lens that Katzenberg looks at the world through, and as he should. He was very successful in that world. But serialized short form vertical content is blowing up because it makes sense. His core thesis about, people needing to tie into narratives in the 5 minutes they have between meetings, like, 100% right on. But this is part of what I was talking about, the cultural perspective, the lens that, that folks from the traditional media world look at the world. That's the opportunity. That's exactly it. It was Katzenberg, I think, had exactly the right idea from a creative and a format perspective, and couldn't detach himself from the way content had always been made to see the opportunity that's now materializing around these short form serials. So I love the Quibi example.
All right. Well, we just nailed it. It's the Spiridellis Brothers studio. It's the Quibi for the AI digital age. How's that?
There you go. I love it.
well, listen, man, I'm really excited to hear about this. When you think about folks who are trying to use this technology, trying to figure out the proper, use, I don't mean proper, use cases that make sense, that actually will have an audience, will be the sort of thing that it can kind of iterate, and you can, find new audiences, not just here, but globally, and do it in a way that, is allowing more and more creators, because I think that's really what you want to do, is kind of enable creators and create an infrastructure where you're just kind of turning the existing stuff upside down on its head. So I think it's really cool, man. I'm really excited for you and your brother.
Thank you, man. It's great being on the pod, and I really appreciate the opportunity to tell our story. We're really excited. It's going to be a lot of change coming. We're looking forward to helping define it.
Well, the other thing is, I'll just say, while this conversation, I really enjoyed it. When you were on Fast Money on CNBC with me last week, I think your sort of insights, I think a lot of investors out there who are just kind of locked into Disney streaming service or what Netflix is doing, and all the changing landscapes with the streaming outside of the traditional networks. I think your insights are really helpful to think about things, because sometimes if you're just like a stock market person, you're looking at these things, you're listening to what the companies are telling you, and most of the time they're going to be wrong, because you know why they're going to be wrong? Because they've told you by their actions how wrong they've been over the last 10 or 15 years. So it's really great hearing a voice like yours kind of help us think about what the future might look like.
As a former investment banking analyst, I can tell you it's a very dangerous time to just be plugging in a growth number on the existing services and thinking that's the way the world's going to play out.
Well, you heard it here first from an ex-Bear Stearns banker here, guys. We'll put the Goldman Sachs on your resume there. All right, Greg, thanks so much, man. I appreciate it.
Yeah, thanks for having me, Dan. Appreciate it.